The world is watching the 2026 US-Israel-Iran war unfold, but we're going to zoom out. We are looking at how the physical reality of this conflict is sending out massive, immediate, macroeconomic shockwaves literally around the entire globe. We're going to break down how battles on the ground are fundamentally reshaping the global economy, the international money system, and ultimately, the purchasing power of the money sitting right there in your wallet.
Here's our roadmap for today. 1. Choking the Strait. 2. Phase 1, dollar strength. 3. The rising cost of war. 4. Phase 2, dollar weakness. And 5. The global currency shift.
Part 1. Choking the Strait, the physical choke point.
Okay, so to understand the money, we actually have to understand the geography first. The whole economic shock really kicks off with a physical blockade at one of the world's most critical maritime corridors, the Strait of Hormuz. At its narrowest point, the water separating Oman and Iran is just 54 kilometers wide. 54! To put that into perspective, that is basically the distance between Washington, D.C. and Baltimore. It's tiny. And the actual navigable shipping lanes? Just a few kilometers across. It's an incredibly fragile choke point, and recent attacks on ships have rendered it, well, virtually impassable.
And here's exactly why that specific stretch of water completely dictates global finance. 20 million. That's the average number of barrels of oil shipped through the strait every single day. We're talking about nearly a quarter of all seaborne oil trade on the planet, mostly heading to major markets like China, India, and Japan. When this route gets choked off, millions of barrels are just trapped, and it creates an absolutely massive supply squeeze.
But wait, it's not just oil. 20% of the world's total liquefied natural gas, or LNG, travels right through that exact same route. Major exporters, like Qatar and the UAE, they rely on it almost entirely. So closing off that little 54-kilometer gap, it triggers an immediate, severe, and wildly volatile energy shock across the globe.
Part 2, Phase 1, dollar strength. The short-term reality.
Let's look at how this bleeds into global financial markets. Because the big question is, what happens to the world's money when the oil simply stops flowing? JP Morgan gave us a fantastic framework for this, breaking the market reaction into 2 distinct phases. Phase 1 is what we are living right now, immediate dollar strength. And Phase 2, which we'll get into in a minute, is the looming threat of long-term dollar weakness. It's kind of counterintuitive, right?
So why exactly does the dollar surge the second a war breaks out? Well, there are really 3 reasons. First, when markets panic, traders get hit with margin calls, and they desperately need US dollars to cover them. Second, since oil is priced in dollars, a sudden spike in the price of crude means countries literally need more dollars just to buy the exact same amount of energy. And third, unlike back in the 1970s, the US is a net energy exporter now. That makes its economy uniquely insulated from this petrochemical supply squeeze, especially compared to places like Europe or Asia.
You can see this safe haven flow perfectly with the US dollar against the Japanese yen, which has been nearing that massive 161 mark. The yen is under immense pressure because Japan is so heavily reliant on energy imports. It's gotten so extreme that Japanese officials are openly discussing intervening in foreign exchange markets just to protect their currency from this absolute dollar onslaught.
Part 3. The rising cost of war, the financial burden.
While the dollar is flexing its muscles right now, we've got to look at the direct, physical financial burden this conflict puts on the United States itself. Estimates suggest the military campaign, operations, maintenance, troops, weapons, all of it, is costing the US roughly $12 billion every single week. That means the US is essentially burning through the equivalent cost of a brand new aircraft carrier every few days just to keep operations going. And of course, that weekly spending doesn't just vanish into thin air. It gets piled onto the existing US national debt, which is sitting at over $39 trillion. Out of that, about $31 trillion is publicly held debt, which pushes it to roughly 100% of the US gross domestic product. To put that in perspective, we literally haven't seen debt-to-economy ratios like this since World War II. Here's the crucial takeaway. When a country's spending vastly exceeds its income, creating these massive deficits, foreign investors and governments naturally get pretty nervous. We're just looking at the impartial economic reality here. Regardless of the politics of the war itself, this intense budget pressure intersects directly with global money. If a nation starts looking financially overstretched, foreign central banks might really start to rethink how much of its debt they actually want to hold.
Part 4. Phase 2. Dollar weakness, the long-term threat.
Which brings us right into Phase 2. How does this conflict, which spiked the dollar right out of the gate, actually threaten its structural dominance in the long run? JP Morgan highlights 3 pillars of future dollar weakness. Step 1, as countries start prioritizing their own defense and energy security, they're going to recycle fewer of their savings into buying U.S. assets. Step 2, rising risk premiums. Policy uncertainty and unilateral geopolitical moves make U.S. assets look, well, riskier to foreign buyers. And step 3, the ultimate tail risk. It's a low probability but a catastrophic scenario where major oil producers start pricing oil outside the U.S. dollar system entirely, whether reacting to U.S. policies or just seeking financial alternatives.
Part 5. The global currency shift. De-Dollarization.
So this leads us to the final macroeconomic consequence of the 2026 war. Nations aren't just sitting back watching this happen. They're actively responding. To really appreciate this, let's map out the timeline. Back in 1944, the Bretton Woods system anchored global finance to the dollar. In 1971, the US took the dollar off gold. By 1974, the informal Petrodollar deal cemented the dollar as the primary currency for the oil trade. Fast forward to now, and the 2026 Hormuz crisis is acting as a massive stress test on that entire system, accelerating shifts that honestly were already quietly underway.
You hear the buzzword de-dollarization all the time, right? Let's clear up exactly what it means based on our sources. It does not mean the dollar is just going to disappear overnight. No way. It simply means countries are actively reducing their dependency on the US dollar for global trade and their own financial reserves. It's essentially about nations diversifying their economic risk.
I absolutely love this analogy from the source material because it takes a super complex topic and makes it completely relatable. It goes like this. If friends always borrow from one wealthy neighbor, that neighbor has leverage. But if they trade among themselves, that leverage shrinks. That is the exact mechanical reality of de-dollarization. Countries are literally trying to shrink the leverage the US financial system holds over them.
And we are seeing this happen in real time, with the war acting as a huge catalyst. The European Union is heavily promoting the euro for regional trade to insulate itself. China is actively expanding its cross-border payment system for the yuan. India is out there exploring bilateral agreements to buy oil directly using the rupee. They're all trying to build parallel financial pipelines so they don't get caught in the crossfire of US financial sanctions or imported dollar inflation.
Which leaves us with this massive, provocative thought to end on. The dollar won't vanish tomorrow, but the global financial tectonic plates are moving faster right now than they have in decades. So is the 2026 conflict the ultimate catalyst that finally fractures the dollar's global reign? It's the question that will likely define the global economy for the next century. Thanks for joining me on this explainer, and keep your eyes on the data.